Good morning. This is Larry McMillan with a stock market update on Monday, June 6th, before the market opens. So things haven't really changed much. The overall intermediate term trend is still bearish, but the short term trend is bullish due to the oversold rally that's taking place. So S&P a week ago had managed to rise up above its 20-day moving average and ran into some resistance around 4150. That resistance has developed into a tight trading range between basically 40.70 and 41.70, and we're still inside that range right now, even though Friday was a fairly large down day, and then tonight, Sunday night, leading into today, the market is up quite a bit. The futures are anyways. But this is still a battle between the bulls and the bears in this particular range. If it breaks out to the upside from here, it could probably carry to 4,300, which is where we see fairly strong resistance. A move above 4,300 would be interesting and perhaps much more bullish than people are thinking right now. We're not expecting that, but it's a possibility, of course. Anything is. On the downside, there's support at 3,800 to 3,900. That's the lows of last month. If that was broken on the downside, we'd probably set up a whole new leg to the bear market. So this is a crucial area we're in right now, this 40.70 to 41.70 area, and we'll see which way it breaks out from here. The equity-only put-call ratios are on buy signals. They did wiggle higher late last week, and to the naked eye, it looks a little bit worrisome, but to the computer analysis programs that we use to analyze those charts, they're saying that the buy signal is still in effect. Breadth oscillators gave buy signals over a week ago, and they're barely clinging to those buy signals right now, but they are still barely on those buy signals. So if breadth weakens from here, let's say if it were to be negative today or largely negative tomorrow, that would probably roll those up back over to sell signals. New highs versus new lows. Things have improved there. We're seeing new highs starting to be greater than new lows, but that's mostly because new lows have disappeared pretty much. New highs haven't really increased all that much. So by the way we interpret this, this is not a buy signal. It's probably just a neutral reading right now. If the number of new highs on the New York Stock Exchange starts to increase over 100 per day, then that would be a buy signal. The volatility index, VIX, is still giving us a buy signal in terms of what we call the spike peak buy signal. That actually occurred back on May 11th, and so it is still in effect and will be for another week or so. But in the larger, longer-term trend picture, VIX is bearish for stocks because VIX is still trending higher. The 200-day moving average is rising, and VIX plus the 20-day moving average are both above the 200-day. And then the last indicator that we look at is the construct of volatility derivatives, and that's positive, mildly positive, in that the term structure of the VIX futures slopes slightly upwards on the front end. So putting it all together, we're still maintaining a core bearish position because of the downtrend in the S&P chart and the uptrend in the VIX chart. Those are intermediate term signals. On the short term, we do have some long positions in place in line with the buy signals from the various indicators that became very oversold and then generated buy signals in the last couple of weeks. So we are maintaining that posture, and we'll continue to update these things daily in our daily newsletter. So I invite you to visit our website and take a look at those. And meanwhile, have a great week trading.